Okay, so thank you, Kyle, for hopping on today and to talk about automated trading systems and building algorithmic futures, kind of more about yourself. So I'm here with Kyle Schultz, who runs Algorithmic Futures, which provide trading systems that allow you to auto trade your strategies, mostly with futures in your trading account. So he runs that. He has multiple systems, and he's going to talk about that later in the video. But Kyle, tell me more about yourself, kind of where you came from, how you got into automated trading, and what you do.
Yeah, absolutely. I'll dig into my background. I've got a unique kind of pathway into algorithmic trading, and I've done a lot of different things within finance and investing to get here. But by way of background, I'm Kyle Schultz. I'm managing director of Algorithmic Futures. Like you mentioned, we offer automated trading systems. Originally from Chicago, so if you know anything about Chicago, it's kind of the heart of prop trading. It's got tons of prop trading firms that all were born out of the exchanges there. The Board of Trade, Chicago Board of Trade, and then the CME, right? So,
Yep.
growing up, I had my brother's friends who traded at different prop trading firms, and it just seemed like the best job in the world, to be quite frank, right? Because intellectually stimulating. You're only working market hours, right? So they could be golfing by 3 p.m. and at the end of the day, they did pretty well. And so I kind of saw that and gravitated towards it, and just started getting more interested in technical analysis, and prop trading in general, but kind of figured out I had a lot to learn. Coming out of undergrad at University of Iowa, it was 2008, and a lot of those prop trading firms stopped hiring traditional traders and really just wanted quant traders, and developers, to be specific. So I didn't have that type of background, so I found it difficult to get into a prop trading shop. But ended up in investment consulting. So we were allocating capital for different pension funds, endowments, and foundations, which was really interesting. And I was doing manager research both for traditional stock picking long equity managers, but also hedge funds. And obviously hedge funds were much more related to the prop trading world. So I took a deep interest in that, and it was a good place to cut my teeth. And then ultimately ended up at Jackson National, which is a $200 billion insurance company. So I was allocating capital to different hedge funds there. But because we managed so much money, we really could only allocate capital to the largest hedge funds, the AQRs, the Brevin Howards, the Bridgewaters of the world. And so I became fascinated with the CTA space. I ended up going back to school at University of California, Los Angeles for my MBA, finished the CFA program, and started to learn a little bit of R from my data analytics classes, and that kind of sparked a renewed interest in trading for me. I always had the mindset of a quantitative trader, I just didn't have the skill set. So once I picked up R, I got really into backtesting different types of strategies, and ultimately developed a CTA and then algorithmic futures, to focus on trading. Um, I found it difficult to break into the industry, to be completely honest, because I wasn't spinning out of a large hedge fund or anything like that. I didn't have the pedigree that a lot of top CTAs and traders have. So I really just developed my own CTA and started fundraising, and developed different strategies in the futures markets and options on futures. And the CTA space is very similar to the systems trading space. I'll explain the differences later on when we get into algorithmic futures.
Sure.
But that was kind of my progression towards ending up in trading and running CTA and then algorithmic futures.
Super cool. Yeah, you have quite a unique background because a lot of people that get into the space, maybe they come from a computer science background or some type of math degree, and then they maybe start at a hedge fund. So it sounds like you kind of you having that business background and then being able to apply that to the insurance company you worked at and managing capital with hedge funds. That's super cool. One thing I just wanted to clarify: if you guys don't know what a CTA is, it stands for Commodities Trade Advisor. Just so you guys know, because some people may not know. People might think it means click to action or something like that, or call to action. So I just wanted to clarify that. Super cool, Kyle. Awesome. And I wanted to kind of harp more on how'd you get into like traded and automated trading specifically? Like, what was the year? Were you trading in college? Were you trading in high school? When did that start?
Yeah, so as I mentioned, my brother's friends were prop trading. I got
Hmm.
into kind of more traditional equity analysis. But the tough part is like when I went to school, in undergrad, they didn't have financial engineering degrees, at least for undergrad. They had kind of master's programs that started to develop after that, but they weren't really teaching prop trading and trading in general. So I gravitated a little bit more towards traditional equity research, asset allocation, portfolio optimization, and just more of the traditional academic route. So like, but
Mhm.
all of my experience in trading and developing trading systems has been more grassroots, right? So like you mentioned, I don't have a quant background per se. I didn't study computer programming or do a master's in financial engineering. I had a little bit of data analytics that I picked up during business school, and I kind of ran with that and really learned through iteration on Stack Overflow, right? So,
Yeah. Yep.
I'd start to develop stuff and then go to Stack Overflow and just kind of learned it by myself.
Cool.
And was kind of utilizing both R and Python for my back testing engine until I discovered TradeStation and TradeStation Easy Language.
Yep.
Um, so that kind of gives you a background about how I kind of got into quant trading, even though I don't have a traditional computer development background or really a super quantitative background. I understood the trading very well because I was interviewing hedge funds and allocating to hedge funds, but kind of picked up the development piece by myself.
Cool. That's so cool. Yeah, and I'm the complete opposite. I came from a computer science background. I didn't know much about trading, and so I kind of had to find that happy medium of, yes, I know how to code stuff, but you also know how to think like a trader, diversification, make sure your strategies are not correlated and stuff like that. Make sure the strategies are built correctly, and then we'll go more into that. So, you already mentioned it. My next question was what broker and software you use. So you did say you use TradeStation, and obviously they have the easy language, programming language, if you will. And I guess did that kind of force you to go into futures? Like, what made you start going more into futures than equities?
Yeah, so there's a couple reasons. The original strategy that kind of sparked my interest in back testing and starting my CTA was I was focused on trading iron condors. I don't know if you're familiar with that, but it's an
I am,
option
yeah.
strategy where you're selling a call spread and a put spread with the same maturity. Works best in sideways markets. In down markets and up markets, usually you've got to rebalance the position, and you might, for example, in a down market, you might rebalance and take a little bit of a loss, but when you reset the position, it's typically at higher implied volatility, so you get more premium in the future, right? So
Yep.
it's a strategy where it works well in sideways markets, but it can also do well in bear markets like we're seeing this year, especially if it's not a very violent down market. It's more of just kind of a downward trending market like we've been seeing, or like 2001 and 2002.
Mhm.
So started back testing option based strategies. And then when I wanted to register for a CTA, CTAs are specifically focused on the futures market. So I really started to hone in on those markets, and there's a lot of benefits, right? You essentially get free leverage through margin trading. So in the stock market, you might have to pay a cost to borrow to your brokerage. In the futures market, everything is traded on margin, and so you're inherently have leveraged positions, but there's no cost to that leverage. So there's a lot of capital efficiency within the futures markets, and then you also have exposure to a variety of different markets, whether it's commodities, interest rates, currencies, or equity indices, which can be very uncorrelated.
Mhm. Cool. Super cool. Yeah, I like that you mentioned the kind of sort of the free leverage, if you will, when it comes to futures. Obviously, you have to have the capital to be able to enter that position, right? The CME sets the rules,
Yeah.
but that is one of the biggest benefits. And personally, I love futures too because it's so easy to diversify and to like build a system for indexes and then build an oil system or a gold system. Um, Obviously, with equities, there is ETFs for sure, but usually the liquidity is a bit lower, right? Like if you look at oil and natural gas ETFs, if there is any, the volume is a bit lower, and it's just really a lot easier with futures. So that's one of the main benefits that I talk about as well on my channel. Um, okay, that's awesome. So my next question is, I know it's a little bit of a doozy, but and there's many more best practices, but when more specifically when building automated trading systems, um, we'll pick three for now, but what are like the three best practices for building automated trading systems? Because anyone can code one, anyone can go into easy language, or personally I use NinjaTrader and go into NinjaScript and, buy on Monday, sell on Friday, or buy on an SMA crossover. What are kind of like the three best practices that you would say help you find success in automated trading?
So the biggest issue in quant trading is overfitting, right? With quantitative trading, you can create whatever strategy you want based on different signals and parameters. But ultimately, you really have to, if you don't focus on robustness, your trading out of sample is not going to be as good as the back test. And so a lot of people fool themselves into thinking they have great trading strategies when they've just overfit the data to a specific time period. Uh,
Mhm.
so, so a couple different ways to avoid that is one, don't use 10, 20 parameters, right? Focus on a handful of parameters, whether that's two or three. I find that that's kind of the right number, because the more parameters you add, the more complexity you have in your model. And then the more you're specifying each of those parameters to the market. So I would stick to only optimizing a couple different parameters. And then two, what I would do is I would use walk forward analysis. And specifically within TradeStation, there's cluster walk forward analysis. So in walk forward analysis, you're using different time periods of an out of sample and an in sample period. Typically, in sample, you can use 70, 80%, and then out of sample, use 20, 30%. What a cluster walk forward analysis does, it actually varies the in sample and out of sample period over the walk forward. So if you have a 10-year time period that you're running a back test on, you might cut that into two-year periods, and you have an in sample, out of sample, and you're walking it forward every 2 years to understand if those parameters that you're using are robust. And I can go into a lot more detail, right? TradeStation has specific parameters to determine the robustness and efficiency, which you can tweak. But ultimately, you're trying to make sure that those parameters, if they change significantly from period to period, you probably don't have a very robust back test. And going forward, you're not going to experience the same type of performance that you did in the past. Um,
Mhm.
so those are kind of two of the main things. And then also, I think the third thing is you want to look and inspect. You want to back test over, and this is controversial, but you want to back test over long periods of time. And the reason I do that is because I use the back test because I want to inspect each volatility event or each period that the strategy did not perform well and really actually logically understand what was happening, look at the trades, look what was going on in the market at the time. Was it, an inflationary period like we're experiencing now, where interest rates increasing, decreasing? How much quantitative easing was there? Because if you're just back testing over a specific regime, take for example, 2010 to 2018, right? Period of massive QE, interest rates were zero, there was no inflation. When you have a regime change, your strategies aren't going to hold up probably. And I think it's what we're
Yep.
seeing with a lot of quant strategies this year, because the market regime this year is much different than it has been in the past. So I do like to look at very long-term back test. I'm not necessarily optimizing to the longest time frame, but I'm researching and analyzing the data over that time period.
Perfect. Yeah, I would totally agree with what you said. I definitely follow some of the same steps as you. I think specifically with walk forward, one of the rules that I've recently developed that has helped me kind of cut out some bad strategies is sometimes when you test your initial idea and then you run your walk forward, and then say you have a test period of maybe a year or 2 years, and then your optimized period is like 2 years, for example. If the test period accounts for more than 50% of the total net profits of the walk forward test, usually that's a red flag because that means in that year, just your strategy did very well, but it could not perform better in the other test periods, right? And vice versa. If your parameters, if you slightly optimize them and your walk forward changes a lot, right? Like maybe the net profit goes down by 50%, or even up, and there's so much volatility, that's usually a red flag of like, hey, your strategy is not too robust. So I like that a lot. And then also talking about the volatility periods, I think that's big too, because if you understand how your strategy performed in a certain event, for example, let's say in '08 or COVID or the red years of 2015 and 2018, I think it helps you also help build future strategies to complement it, right? So, for example, maybe you have a seasonality strategy that trades oil and it does well in these months, but not well in the other months. Well, you could build a strategy to complement those other months, trading a different asset on a different time frame, sort of thing. So, I think those best practices are very sound. It's something that I follow as well. So that's really cool. Um,
Yeah,
I
one
so
one thing I also want to say is like you bring up a good point. Like each volatility event has very different characteristics, right? So what you saw happen in COVID, incredibly violent and quick down market, and then recovering pretty significantly and quick, is much different from the time period we saw in 2008, and also from if you go back to 2001, 2002, we had just kind of a deflating of the tech bubble that occurred over a 2-year period, right? And so the depth and the speed of volatility events is much different. So when you understand how the strategies perform during each of those volatility events, you have a better perspective for going forward.
yeah, I agree. COVID was very violent downside and then upside where '08 took a longer time. It took multiple months to recover. I think over a full year. And then 2000 and 2001 were a lot longer too. So um, that's something to take into account. So very interesting stuff. I love it. I would definitely agree with those best practices. So my next question is, um, you may be able to be able to talk more about this, but a lot of my audience and my viewers, they have a 9 to 5 job, and then they build their own trading systems on the side and they run them, either on their local computers or say on like a VPS or something like that. What would you say are some tips and tricks to I know automated trading systems are automated, but is there any tips that you can recommend for like running automated systems if you have a job already, and things to kind of watch out for, maybe if you're new?
Yeah, absolutely. So you and just to kind of elaborate on what you were mentioning is like after business school, I also worked in private equity and work in M&A and investment banking, right? So I've done a lot of different things within finance and investing. But I've always had a passion for trading that I've developed my trading systems really on the side. And I did the CTA for about 2 years full time, but ultimately um, had trouble with the fundraising side of the business. And that's why the systems business is great because I can use digital marketing advertising to bring in clients and really just kind of go out there on the internet, set up shop, and everything's automated, right? So
Yep.
it's very scalable and can be run really with not a lot of hours per week or per month, focused on just more marketing. Now, that business, I have a broker partner called the Fox Group, and what they do is they handle all the onboarding and all of the administrative aspects of running the system. So they monitor the systems all day. Like you said, even if you have automated trading systems, things go wrong. Whether you're using NinjaTrader or TradeStation
Yep.
or whatever it is, you have to keep an eye on it. But there's ways to stay in tune with what's going on with your trades. Well, I get notifications to my phone, and honestly, I know my strategy so well that based on the time of day or what contracts being traded, I know what strategy it is, right?
Yep.
So technology like that helps, but I do have a broker that's full time monitoring all the systems and all my customers' accounts. And then they also help with rolling futures contracts and doing trade allocations and all of that. So algorithmic futures is a really nice systematic trading business because I've got a broker that's kind of handling all the administrative aspects, and then I can focus on developing strategies and marketing them online. So a couple of
Cool.
tricks, is definitely to use a VPN, like you said. If you have like a remote desktop, like whether it's AWS or another system, it just helps reduce interruptions to your trading systems, and you can
Mhm.
kind of log in whenever you need to check on things. And then also the frequency of your trades. It's important. If you're incredibly active, you probably have to monitor the trades a little bit more to make sure everything's trading correctly and make sure there's no issues. But if you're doing, for example, long-term trend following where your hold periods are weeks, days or weeks, it's probably easier to automate it. You have less buys and sells, and there's less surveillance and monitoring of the systems required.
Cool. I like that. Yeah, definitely recommend VPSs. I use AWS myself, and it just saves me all the hassle. Like if my power goes out, my internet goes out. There's actually a condo building being built near my office, and sometimes the power goes out. Like not recently, but like about a month ago, because they're probably hooking stuff up. And if my system was running on my local computer, it would be turned off, right? So, but it was running on AWS, so that was not an issue. So yeah, definitely. And that's really cool that you work with that broker partner. I think we'll talk about more about that at the end. And one of the benefits that if people go work with you in Algorithmic Futures, they can see that. So that's really cool. Okay, cool. My next question is, and the second last one, what are your, so there's intraday and long-term trading strategies, right? So there's pros and cons to both. I find that some intraday systems can have more noise and more randomness. However, you can usually have less risk, higher Sharpe ratios, less stress running intraday systems, and exiting before the settlement session. But swing trading systems can be also very stressful, especially if you're always in a position. So, what are your thoughts on developing systems for intraday versus swing? Do you want a mixture of both? How do you handle the risk to reward on those two types of kind of strategies?
Yeah, so I like to, an algorithmic futures portfolios are really diversified between what you would call swing, which I think of as like days to weeks holding period, and then intraday strategies. The market microstructure and the market patterns can change for intraday periods and also by weeks and months, right? So you might have periods where intraday strategies perform incredibly well and your swing strategies are not performing well. But it's just another layer of diversification, in my opinion. The benefit you do get from intraday trades is you tend to have a larger sample of trades in your back test, which is helpful when you're thinking about robustness. And then swing trades, there might be fewer trades over a month or years or over the back test period you're looking at. So you've got to be a little bit more skeptical with it and maybe just tweak some of your thresholds for what you consider a robust strategy, in my opinion. So I like the intraday strategies because there's a larger sample size. But
Mhm.
ultimately, combining those strategies in a portfolio provides another layer of diversification. So you can think of diversification from like, okay, what markets are you trading? Commodities, equity indices, treasuries, currencies, um, types of strategies, momentum, mean reversion, and time period of strategy, intraday or swing, right? So the more the more diversification, in my opinion, that you're able to put into the portfolio, the better it's going to perform over longer periods, and the less periods of drawdowns that you're going to experience.
Cool. Okay. So overall, it's just better to have both if you can, and just the more time you spend developing, eventually you get to a point where you'll have some intraday, some swing systems. What I like to add is looking at specific times of the day. There's actually lots of research papers talking about. I was just reading one the other day of like if correlation with overnight returns versus the first 20 minutes or the last 30 minutes of the session. Now the research papers that I read were on equities specifically.
Mhm.
But I think when it comes to intraday systems, maybe do some like probability and like statistics on okay, what happens in the first 30 minutes of the day if the overnight returns are positive or negative? How are they correlated? And then building a trading system around that. And then obviously, does it perform in the walk forward? But I've been developing more intraday systems because I sort of started with a lot of longer swing trading systems, like you said, days and weeks. And I would say those are sort of easier to build because there's less noise. But the problem is sometimes when you're actually running them live and they're not going your way because they take days or weeks to exit, it is sometimes painful, and you want those intraday systems to maybe make some quick returns to kind of offset that. But anyways, that's more of the psychological aspect of running these systems. So
Yeah, no,
um,
that makes a lot of sense, right? You have to understand your risk threshold and how you're going to react to these strategies. And if you're not going to follow the systems, then you've got too much risk in the strategies, or it's not the strategy for you, right? So
mhm.
it's one thing to run a back test and see a drawdown and a drawdown duration on paper,
Yeah,
and then
yeah.
it's a different thing to live through that, right? So those are just, I think, if you're starting out trading, Doing paper trading and then getting into live trading will help you kind of with your emotions and sticking to the systems, right? So you can develop great systems, but you also have to stick to the strategies and be able to ride out the drawdowns.
That's right. Yeah. And I know a lot of the back tests I do, I just look at the net profit parameter. I'm like, sweet, it made, 100K over 10 years. That means I'm going to make it. And it's just not the reality. Sometimes you have to let the systems play out. And one of my early mistakes too was kind of overriding my systems by closing the position manually, just because I couldn't handle it. And I think that just says that like I wasn't able to handle that strategy, the drawdown, and you have to be able to realize that. And I usually recommend when you're building systems, like having them all in some type of an Excel sheet or some type of like organizing tool to say, hey, these are all my systems. Here are the max drawdowns, maybe the average monthly profits, that sort of stuff. And that way you can kind of prepare yourself. And yeah, paper trading too. I would say that especially any new system you build, you probably want to paper trade it for a period of time, just so you can get accustomed to it. So that's really good stuff, Kyle. Thank you, appreciate it. My last question before we talk about algorithmic futures, what are some realistic goals that automated traders can set? Like, what do you personally set in terms of, are you looking at a yearly return basis? What's your return to drawdown? Like, what kind of goals can people set that are realistic and that help them kind of achieve and kind of motivate them to get past the hard times and the good times?
Yeah, I think that's a good question because when you get interested in trading, or if you're just starting out in trading, sometimes you're looking at backtest or you're looking at some of the top hedge funds or other traders that you know, and it's very difficult to untangle skill and luck in trading unless it's over a very long period of time, right? So you could have had a trader that did incredibly well in 2020, and they're just getting crushed this year, right? So it's very difficult, and it takes a long period of time to really see if you're a skillful trader or you just got lucky in a specific market, right?
Mm-hmm.
So I think, and sorry, going back to the question, I think there's a lot of different things you have to think about, but if you look at return to max drawdown, usually you want to target, like, a great strategy would just be a 2 CalMAR. That's a CalMAR ratio is annualized return to max drawdown. So if you're able to develop a strategy that does 30% annual return with a 15% max drawdown, I think that's a great threshold. And even if it's in between a 1 to 2 CalMAR, that's realistic, right? And when you combine them in a portfolio, you might get some benefits of diversification to reduce that max drawdown. So that's one of the benefits of having multiple different types of strategies in a portfolio. Is like you might have a couple different 1-to-1 CalMAR ratio strategies, but they're uncorrelated. And when you combine them in a portfolio, that reduces your max drawdown and increases the CalMAR ratio of the total portfolio to 2.
Mm-hmm.
So I think that's one thing to focus on. In the institutional world, or within the hedge fund world, a lot of people use Sharpe ratio, but there's definitely some drawbacks to Sharpe ratio because that's annualized return to standard deviation, and it really doesn't differentiate between upside deviation and downside deviation. So I think understanding which risk return metrics work best for you or how you think is important. But I like return to max drawdown, and if you're trading with leverage, max drawdown is what you care about, right? Because
Yep.
your whole goal is to have a capital efficient portfolio and optimize the return so that, for me, like I try to create portfolios where you're not going to get a margin call. Now, there's always risk of margin call, but from my back testing, the way I set up my portfolios, you're able to use the least amount of capital to not get a margin call and then increase returns, right? So it's kind of an optimization game with futures and capital. But yeah, if you can develop 1 to 2 CalMAR ratio type strategies, you're looking in the right place and developing the right types of strategies.
Awesome. I would totally agree. I think um, that's sort of the best realistic goal. You could also go simpler and say, hey, I'm going to develop, 5 to 10 systems this year in these markets. And those are very achievable goals. And then the end goal is to, have a profitable year, right? Because that's the whole
Yeah,
goal, to make a positive net return. Obviously, you can set that goal. It's really hard to predict that. You never know what's going to happen. But as long as you're, doing these best steps that we talked about, walk for analysis, diversification, the cluster walk for analysis that you talked about too, and building systems right. I think you're headed in the ship is in the right direction, right? So I love that. Cool. Awesome. Okay, well, appreciate it, Kyle. So I wanted to before we wrap up here, I wanted to talk more about Algorithmic Futures, which is your kind of product for automated systems. I'll be linking it in the description below as well in the comments where they can find you. But talk about more of the kind of the systems you have and some of the products you offer.
Yeah, absolutely. So I manage a website called algorithmic-futures.com. There's a dash in there
Yeah.
where I offer different trading portfolios that I've created to clients. And like I said, we use a broker partner with all the onboarding and to handle all the administrative aspects of setting up the account, rolling futures contracts and whatnot. So it's 100% automated hands-off trading. And essentially everything that I've developed, which is really 5 different portfolios focused on intraday momentum, intraday mean reversion, and then swing trading momentum and mean reversion, and trend following. It combines all those strategies in different portfolios ranging from account sizes as small as 15K up to 65K, right? So the larger the account size, the more strategies you can add and different types of strategies. So they tend to perform better the larger the account size you have. But it's a way for customers who are interested in trading. Maybe they're a discretionary trader and they've just had a really tough time and they're starting to understand that, hey, look, I like trading and I want a good return on capital, but I can't focus on the market 24/7, and maybe they utilize algorithmic futures as a portion of their portfolio. Or you have different types of people that trade long only equities and bonds, which have not done very well in bear markets, right?
Hmm.
So they want to diversify into types of strategies that can outperform in a bear market. And you can go to the website and look at some of our live performance and back tested performance to see how strategies have behaved during different volatility cycles and events. Most of the systems are up and doing very well this year, and the systems focused on trend following within commodities have done incredibly well this year. So yeah, I'd urge people to go to the website, poke around, and understand how we develop our systems and see if they're interesting for you, or even just to break off a portion of your portfolio and allocate to those types of strategies.
Perfect. Awesome. Yeah. So once again, that link will be in my description and comments below. That's algorithmic-futures.com. Definitely give that a look out. I think you have some really cool systems there, and you've definitely added some new ones too. Because I remember checking out your website a couple months ago. So it's cool you're adding new systems in the future. So that's really good to see. That's all I had, Kyle. Thank you, man. I appreciate your
Yeah, no,
time.
I appreciate it.
Yeah, we had some
Yeah.
good chats and lots of gems, and I think a lot of value in this video. So thank you so much, and we hope to see you soon.
Yeah, thanks for having me. It was a great discussion. And if anyone has questions, feel free to reach out to me. I'm glad to talk to any other traders. And thanks for the interview.